Hi everyone, Jasper Basson here. Thank you very much for watching. We will look today at the exercise to do a cash flow projection. A cash flow projection is exactly what it says. It's a projection of the cash that you receive every month or in a specific month from your customers or from various other places, and also all your various expenses, including your monthly repayments on revolving credits, business loans, installment sales. So it's really an exercise of all your income and expenses that will potentially flow in and out in that specific month. So let's go and look at the exercise. Right, let's look at this exercise for cash flow projection for March 19 to February 20. And it's very important to note that these dates are not necessarily, this is a financial year end, but it does not necessarily need to be March to February. We're currently, as I'm recording, I'm in August. So if I need to do a cash flow projection for the next 12 months for myself, I would need to look at September to August 2020. So it's really just a matter of explanation in this case, but it's always for a 12-month period, especially if you do it for a financial institution as well. The company, I just call it ABC company. It doesn't really matter for now. It would be your business, and we assume it's a company, and therefore there would be in the bottom here as well, there would be a director's remuneration, and the director's remuneration is nothing else than a salary, especially if the director actually work in the company. It's all in the same thing. Some directors doesn't work every day in the company, and they just get a director's remuneration for being in certain meetings of the company. So let's start from the top. Turnover, in this case, won't be necessarily the turnover that you actually done for the month. It would be the actual cash that you receive that you project that you will receive from the customers. That's the amount that you would put on in your specific month. So you project. I've kept it simple in this exercise. I've done 200,000 for 3 months, 220 for the next 3 months, and so I went on about 10% growth every 3 months. But in this explanation, I assume that all the money actually been received in that specific month, which will never be the case. So you will actually estimate on this turnover the actual amount that you assume or project that you will receive. On the bottom, I've worked on the cost of sales percentage of 30% to sales. And I work it consistently through the program. So my cost of sales is 30%. So if my turnover would be 200,000 for that month, my gross profit would be 140,000 rand, or my gross profit inflow would be 140,000 rand. And you will do the same for your operating expenses as well. So you will go through your accounting expenses, advertising. You will see, I can show you, I've locked in a percentage of 2% on the turnover of the month, and it can vary of various industries, but I've just made a more or less a cap of 2%, because as your advertising grow, potentially sales will also grow, and vice versa. And the same for bank charges. As your sales grow, your bank charges will will potentially grow as well. Then just various expenses. Director's remuneration is also included in this expense, because you will actually pay yourself a salary. Various other expenses, again going to salaries. As your turnover increase, potentially your salaries and wages will also increase. Then telephone as well, same reasoning there. On the bottom, I've got a capital portion, so it would be all the various capital amounts that I would pay. In this case, I've just made 2 loan accounts up. For the example, installment sale agreement would be for a vehicle that you need to purchase for the business, and you need to repay 6,000 rand a month on that vehicle. And the same for a business loan. You would probably need some money up front, and you need to repay that on a monthly basis. And the last line is the SARS VAT. So it's really, if you look at my calculation again, it's really a portion of sales, cost of sales, and all the VATable expenses that I can deduct, and I've added 15 times 115 to show the VAT portion that I need to pay, and VAT is every 2 months. So I've started with March, April, and May, and then May, June, and July, and so it goes on. So at the end of the picture, I potentially have a gross profit portion of inflow that I will receive around 40,000 rand. I do have total cash outflows, including the capital, of around 31,000 rand, and my net inflow of this specific month would be 8,800 rand. So, and that's for every month as we go along, for every month for the 12 months. I've included the opening balance, cash balance here as well. So that would be the actual cash balance on, let's call it the 1st of March or the 28th of February. That would be the amount of cash available in the bank at that stage. So my cash flow would calculate on the actual net inflow for the specific month plus the cash that is already available. So at the end of the month I should have 58,000 rand available in cash, and so this balance carries over until we get to the month end of 12 months in February, and my accumulated net inflow came to 156. Very simple exercise. It can be a lot more complicated, but I'll just stick to the basics of understanding how the inflows and the outflows actually work on the cash flow. And just very important, again, just to emphasize this whole cash flow exercise is really the actual cash that they will receive in and actual cash that they receive out. So it's not amount that the actual fees that you will write, it will be actual fees that you will write and you receive the money in cash. Thank you very much for watching. If you find any value from this video, please remember to subscribe to this YouTube channel, and also please share this with a fellow entrepreneur friend.